Imagine it is 4:15 a.m. You are awake before the rest of the world, not out of necessity, but by habit. You have spent 25 years building a fortress of solvency. Your net worth is in the 8 figures. Your debt-to-income ratio is textbook. You are, by every traditional metric of the 20th century, the ideal client. But as you glance at your phone, there is a notification from your primary private bank. It isn't a greeting from your representative. It is a sterile, automated alert. Your primary line of credit, the one you use for bridge financing and opportunistic acquisitions, has been provisionally suspended. There has been no market crash. Your business hasn't missed a quarter. You haven't moved a cent out of your accounts. In the old world, you would call your banker, a man you've known for 15 years, and it would be resolved by lunch. But in this new world, there is no one to call. The decision wasn't made by a human. It was made by a protocol that detected a behavioral anomaly in a transaction you made 3 days ago. For the man over 40, the most dangerous risk in the current financial architecture isn't insolvency. It is the silent withdrawal of permission. Your assets are still there, but your access has been severed by a piece of code that doesn't know your name, doesn't care about your history, and cannot be reasoned with. This is the new reality of the silent credit shift. To understand where we are going, we must acknowledge the end of the software-only era. Between 2010 and 2020, capital flooded into light assets, SaaS companies, social media platforms, and digital currencies that required very little in terms of physical overhead. This led to a sort of intellectual laziness in the markets. We forgot that every bit of data processed is a physical event occurring in a physical location. Starting around 2021, the world hit a wall. Supply chain disruptions were the first tremor, but the second was more profound. The realization that our digital ambitions have outpaced our electrical reality. The surge in demand for high-performance computing, driven first by the maturation of decentralized networks and then by the explosion of generative AI, has turned energy from a background utility into the primary constraint of capital. We have shifted from a world of speculative code to a world of physical constraints. If the last 20 years were about who could write the best algorithm, the next 20 will be about who owns the electrons required to run them. We are moving past digital gold toward what I call thermodynamic sovereignty. We are currently navigating the most significant transition in the history of credit, the shift from static risk to dynamic risk. In the legacy model, trust was an asset-based concept. The bank looked at what you owned once a year. If your collateral was sound, you were trusted until the next review. This was static trust. Today, we have moved to behavioral trust. It is no longer about what you own, but how you move. The modern financial institution no longer cares about your net worth in a vacuum. They care about the velocity of your capital, the origin of every wire, and the predictability of your spending patterns. If you are a high net worth individual who suddenly decides to move a significant sum into a non-traditional asset class, or if you engage in a transaction that falls outside your algorithmic profile, the system doesn't wait for a human to review it. The risk is now calculated dynamically, every millisecond. Your historical wealth is treated as a secondary metric to your real-time data exhaust. You might be worth $50 million, but if your behavioral data triggers a high volatility flag, your access is throttled instantly. The asset-based safety net has been replaced by an algorithmic permission gate. This leads us to the core mechanism, automated risk protocols. Modern Tier 1 banks have effectively outsourced their credit departments to black box AI engines. These systems utilize real-time data scraping that goes far beyond your bank statement. They monitor global liquidity flows, geopolitical risk, and even social financial sentiment. The shift from annual reviews to millisecond by millisecond surveillance is not a feature. It is the new architecture. These protocols are designed to be hyper-conservative. In the eyes of a machine learning algorithm, a large, infrequent transfer, the kind of move a sophisticated investor might make to catch a market bottom, looks identical to the initial stages of money laundering or capital flight. The code doesn't distinguish between sophistication and suspicion. It only recognizes deviation. Because these systems are automated, they lack the capacity for context. They operate on a guilty until proven innocent basis, where the proof is a grueling manual appeal process that can take weeks. While you are waiting for a human to look at your file, your capital is sidelined, and your opportunity cost is compounding. We have entered an era where your financial freedom is governed by a set of heuristics that prioritize systemic safety over individual liquidity. What makes this shift particularly sobering for the man over 40 is the sheer scale of the integration. This isn't just one bank updating its software. This is a global consolidation of financial rails. When you see a bank de-risk a client, it's often not even the bank's own decision. It is the result of a third-party risk-scoring engine, software used by thousands of institutions simultaneously. This creates a terrifying form of algorithmic contagion. If one protocol flags you, that flag can propagate across the entire fintech ecosystem in minutes. Your credit card in New York, your business line in London, and your private equity commitment in Singapore are all connected to the same digital nervous system. The handshake is dead, and in its place we have a global automated panopticon. To survive this, we must stop thinking like customers and start thinking like architects of our own access. We must understand that in the eyes of the code, we are only as reliable as our last 3 transactions. As we navigate this new landscape, it's crucial to understand how our behavior, not just our assets, affects our financial access. The sober financial behavior of a man over 40, characterized by large and frequent transfers, diverse holdings, and non-traditional assets, now triggers high-risk flags designed to catch money laundering. This is the algorithmic blind spot, where our responsible behavior is misinterpreted by the automated risk protocols. We must recognize that our actions, not just our wealth, are under scrutiny. The consolidation of fintech rails has created a hidden risk, where one algorithmic error can propagate across multiple financial institutions simultaneously. This centralized system, designed for efficiency and scalability, has introduced a new level of vulnerability. As we rely more heavily on these digital pathways, we must acknowledge the potential for systemic failures and take steps to mitigate them. By understanding the intricacies of this centralized system, we can better navigate the risks and ensure our financial access remains uninterrupted. To counter the automated permission systems, we must adopt a strategy of redundancy. This means moving away from a primary bank mindset and towards an access architecture. By maintaining physical and digital redundancy, we can ensure that our financial access remains uninterrupted, even in the face of algorithmic errors or systemic failures. This may involve diversifying our banking relationships, using multiple digital platforms, and maintaining a cash reserve. By taking a proactive approach to our financial architecture, we can build resilience and adapt to the evolving landscape. As we reconcile with a world that no longer respects historical wealth, we must acknowledge the intellectual honesty required to navigate this new reality. Our data, not our handshake, now defines our freedom. The silent credit shift is a wake-up call, urging us to rethink our relationship with finance and technology. By understanding the algorithmic permission systems and adopting a strategy of redundancy, we can ensure our financial access remains uninterrupted. As we move forward, it's essential to prioritize long-term sustainability over quick gains and to approach our financial decisions with a deep understanding of the underlying systems. The future of our financial freedom depends on our ability to adapt and evolve in this rapidly changing landscape.